Welcome back to Crypto Equation, and today we step into one of the most controversial and misunderstood parts of the digital asset world. The belief that XRP's price is not simply the result of market supply and demand, but the reflection of deeper forces that shape liquidity, forces that influence price discovery, forces that push volatility and suppress momentum, forces that long-term holders feel but cannot fully explain. People call it manipulation, but most never understand what manipulation truly means in the context of global markets, because what many call manipulation is often simply the behavior of large liquidity players, hedge funds, automated trading desks, institutional market makers, and systems that operate at scales retail investors cannot see. Today, we are going to expose the truth behind what people call XRP market manipulation, and more importantly, reveal the patterns, the signals, and the systemic pressures that every long-term holder must understand to stay alert in the years ahead. This is not about conspiracies. This is not about secret cabals. This is not about hidden agendas. This is about structural dynamics of modern markets and how an asset engineered for global settlement is influenced by a market structure not built for its long-term purpose. XRP exists between two worlds, the world of speculative trading and the world of long-term financial infrastructure. These two worlds operate with different time frames, different priorities, and different behaviors, and when these worlds collide, the result looks like manipulation, even when it is simply market mechanics. To understand the truth, we must begin with the foundation of modern markets. Markets today are dominated by algorithmic trading, by high-frequency systems, by automated market makers, by institutional liquidity desks that execute millions of microtransactions every second. These systems are not designed to pump or dump assets. They are designed to extract inefficiencies, to control volatility, to maintain liquidity, and to profit from predictable human behavior. The problem is that retail traders often interpret these behaviors as manipulation because they do not understand the machinery behind the movements. But XRP adds an extra layer to this story because it is not just another speculative asset. It is an asset designed for a future financial system that has not fully arrived. This creates a unique dynamic where long-term value is high, but short-term liquidity behavior is heavily influenced by traders who do not care about its purpose. This disconnect between long-term fundamentals and short-term market mechanics creates patterns that look engineered. Sudden rejections at key levels, sharp wicks, controlled price walls, predictable suppression zones, long consolidation periods followed by explosive moves. These patterns are not random, but they are also not always intentional. They are the result of an asset with massive global potential operating inside a speculative environment dominated by algorithms. Now let us expose the first truth about what people call manipulation. Manipulation in modern markets often comes from asymmetry of information, not illegal activity. Institutions have deeper understanding of liquidity flow. They know where retail traders place orders. They know how liquidity pools build. They know how to trigger cascading stops. They understand how to maintain equilibrium. These forces influence price behavior without breaking any rules. This is why XRP experiences such sharp movements during low liquidity periods. Algorithms detect inefficiencies and exploit them. Retail sees a crash. Algorithms see opportunity. Retail sees suppression. Algorithms see a liquidity gap. The second truth behind what people call manipulation is liquidity compression. XRP has unique liquidity characteristics because it is held tightly by long-term believers and institutions waiting for future use cases. When large portions of supply are not actively traded, markets become thin. Thin markets create sharp reactions. Sharp reactions look engineered, but they are simply the result of low circulating liquidity relative to global trading activity. The third truth is market positioning. XRP is one of the most heavily speculated assets in the digital world. Traders target it because its volatility is predictable. They can see where retail buyers and sellers place their orders. They know the emotional triggers. They know the social sentiment, and they use it to create profitable cycles. This creates the illusion that someone is deliberately controlling price. But in reality, it is a battlefield of automated systems. Now let us go deeper into a fourth truth, the invisible pressure created by the global legal environment that XRP has existed within for years. Legal uncertainty created a unique trading environment where large institutions remained cautious while speculative traders dominated the markets. This imbalance created the perfect conditions for extreme volatility, not because someone engineered it, but because the demand side was restricted while the speculative side remained active. The fifth truth behind XRP's market behavior is the absence of institutional price discovery. Most assets find stable price levels through institutional adoption and liquidity. XRP has not yet entered that phase fully because its use case is tied to global settlement systems that are still being built. Markets behave erratically when long-term demand has not yet activated. And this brings us to one of the most misunderstood ideas in the entire conversation, the belief that XRP is artificially suppressed. Suppression does not mean illegal manipulation. Suppression means structural misalignment. XRP's price is influenced by markets not prepared for its long-term role. The infrastructure it was designed to support instant global settlement interoperability, tokenized value movement, and institutional liquidity has not yet gone live at scale. This means the asset is being priced by traders who do not understand the system it will eventually serve. This mismatch creates suppression. Now let us expose the next layer, the psychological mechanics of market behavior. Markets attack fear. Markets punish impatience. Markets amplify uncertainty. This is why XRP experiences extreme reactions to headlines. Traders know the community is emotional. They know how to trigger waves of fear. They know how to trigger waves of hope. These emotional cycles provide opportunities to extract liquidity. But now let us turn to what matters for long-term holders, the blueprint for staying alert and recognizing real signals from manipulated noise. The first component of the blueprint is understanding liquidity zones. XRP often moves in controlled ranges where liquidity builds. These ranges are not random. They represent areas where market makers accumulate or distribute. When price stays within a narrow zone for long periods, it signals preparation for a major move. The second component is identifying engineered volatility. Sudden wicks are rarely organic. They are usually the result of liquidity hunts, algorithmic liquidation, or thin order books. Long-term holders must recognize that these wicks mean nothing for long-term infrastructure adoption. The third component is understanding long-term cycles. XRP moves in slow, powerful waves, not in constant trends. Each major wave is preceded by years of consolidation, confusion, and suppressed volatility. This is not manipulation. This is the natural behavior of an asset waiting for long-term utility activation. The fourth component is the global shift towards settlement modernization. This is the real engine behind XRP's long-term trajectory. As the world adopts instant settlement systems, XRP's relevance increases regardless of short-term volatility. Now let us expose one of the deepest truths of all the majority of what people call manipulation is actually market structure struggling to price a long-term infrastructural asset in a short-term speculative environment. The world has not yet caught up to XRP. The infrastructure is still being built. The rails are still being upgraded. The settlement systems are still being modernized. As long as this gap exists, short-term trading behavior will dominate. Now let us explore why staying alert matters. It matters because volatility hides opportunity. It matters because crashes reveal accumulation. It matters because manipulation often signals preparation. And it matters because long-term holders must understand the difference between temporary noise and structural transformation. XRP's journey is not defined by the price movements of today. It is defined by the infrastructure being built quietly behind the scenes. The second half of this script will expose the psychological traps, the institutional patterns, the structural forces, and the hidden signals that help long-term holders stay alert as XRP moves closer to the system it was designed for. Because now that we understand the foundation of XRP's volatile price behavior, we must go deeper into the psychology and intention behind the movements, because staying alert is not about predicting pumps or panics, it is about understanding the signals hidden beneath the noise. Long-term holders survive, not because they avoid volatility, but because they learn to interpret it. Manipulation only affects those who cannot see the structure beneath the movement. And this structure becomes more visible the deeper you look into how XRP behaves during accumulation periods, distribution cycles, liquidity hunts, and suppression phases. The first thing long-term holders must understand is that markets create predictable emotional patterns, and XRP's community is one of the most emotionally reactive in the digital asset space. This gives traders a powerful advantage because any group that reacts predictably becomes easy to exploit. When fear rises, liquidity dries up. When hope rises, liquidity floods in. When uncertainty spreads, liquidity becomes scattered. Traders exploit this rhythm. They create volatility not to harm holders, but to extract liquidity from predictable emotional reactions. This leads us to the second layer of the blueprint engineered accumulation. Many of XRP's largest upward movements historically occur after long periods of controlled price action. During these periods, price stays inside small, predictable ranges, while volume quietly increases. This is not random. It is not accidental. It is the market preparing for future demand. Accumulation phases look like manipulation because they suppress price, but they are actually preparation phases where liquidity gets redistributed from impatient hands to patient hands. The third blueprint element is volatility harvesting. When the market senses emotional extremes, it triggers opposite movements. When optimism becomes excessive, algorithms sell. When fear becomes excessive, algorithms buy. This creates the illusion that someone is deliberately punishing retail traders, but the real force behind it is automated liquidity harvesting. XRP's large community and high emotional engagement make it a prime target for this behavior. The fourth blueprint element is systemic uncertainty. XRP spent years under legal tension, and this uncertainty created unique opportunities for volatility exploitation. Traders thrive in uncertainty. Institutions wait for clarity. Retail reacts emotionally. This imbalance created a playground where price was driven by speculation rather than long-term fundamentals. The fifth blueprint element is institutional patience. Institutions do not buy at the top. They accumulate slowly during uncertainty. They accumulate when the narrative is negative. They accumulate when volatility creates fear. And they accumulate when retail traders exit. This pattern is visible throughout XRP's entire history, and it is one of the strongest indicators that long-term value is not determined by short-term chaos. Now let us explore the psychology behind the phrase, stay alert. Because staying alert does not mean panic. It does not mean fear. It does not mean expecting disaster. Staying alert means understanding how structural transformation influences short-term price behavior. It means watching the right signals and ignoring the noise. The first signal long-term holders must watch is global financial modernization. Every major region upgrading its payment systems is a signal. Every country adopting digital messaging standards is a signal. Every institution exploring tokenized settlement is a signal. These signals point toward a future where real-time global settlement becomes normal and XRP's architecture becomes increasingly relevant. The second signal is liquidity migration. As global liquidity shifts toward digital rails and tokenized systems, the assets built for fast settlement will gain structural relevance. XRP is one of the few assets engineered for this exact purpose. The third signal is regulatory progression. As more countries finalize digital asset frameworks, the infrastructure for legal settlement using digital assets expands. This environment increases the long-term utility of assets like XRP. Now let us go deeper into the hidden mechanics behind the scenes, the patterns that look like manipulation, but are actually the market preparing for long-term structural transformation. One of these patterns is the long suppression range. XRP spends extended periods in narrow price corridors while global settlement technology evolves in the background. These ranges frustrate emotional investors but strengthen the long-term structure by preventing disorderly price discovery before institutional demand activates. Another hidden mechanic is controlled volatility release. The market often holds XRP inside tight ranges before releasing large directional moves. This is not random. It is a combination of liquidity buildup, institutional testing, and algorithmic positioning. Long-term holders recognize these patterns and remain patient rather than reactive. Now let us expose one of the most important forces shaping XRP's price: institutional invisibility. Institutions rarely move in visible ways. They test quietly. They accumulate quietly. They integrate quietly. Most long-term infrastructure adoption happens behind closed doors. This creates a strange paradox. Retail investors often mistake silence for failure when silence is actually preparation. The blueprint teaches that what the public does not see often matters more than what they do see. Now let us explore the future-oriented side of the blueprint, because market manipulation only appears powerful in markets dominated by speculation. Once utility activates, manipulation loses influence. The future of XRP lies not in speculative trading, but in settlement architecture. Once XRP begins serving the system it was designed for price discovery will shift from speculation to utility. Utility-driven price discovery looks nothing like speculative-driven price discovery. Speculative price discovery is chaotic, emotional, and unpredictable. Utility-driven price discovery is stable, structured, and demand-driven. This is why long-term holders focus on global modernization, not short-term volatility. Now let us turn to the emotional core of this video, the reason retail needs to stay alert. You must stay alert because markets are designed to shake out the unprepared. You must stay alert because the strongest hands win in long cycles. You must stay alert because the greatest opportunities appear during uncertainty. You must stay alert because the world is moving into the system XRP was built for. The blueprint teaches that staying alert means knowing which forces matter and which do not. Global settlement matters. Real-time liquidity matters. Financial messaging standards matter. Cross-border innovation matters. Tokenized asset settlement matters. Utility matters. Short-term volatility does not. Fear cycles do not. Emotional manipulation does not. Now let us examine how long-term infrastructure changes remove the appearance of manipulation entirely. Once settlement systems run on digital rails, once liquidity becomes mobile, once institutions activate demand, once tokenized value requires instant settlement, market forces begin behaving differently. The more useful XRP becomes, the less manipulable its price becomes. Utility is the antidote to speculation. Utility is the antidote to volatility. Utility is the antidote to fear cycles. Utility is the antidote to emotional manipulation. This is why understanding XRP's role in global finance protects long-term holders from reacting to the wrong signals. Now let us conclude with the deepest truth beneath the entire blueprint. People call it manipulation when they do not understand the structure. People call it suppression when they do not understand the purpose. People call it chaos when they do not understand the timeline. XRP is not a typical asset. It is an infrastructural component of the next era of global settlement. Its price behavior reflects a system caught between speculation and utility, caught between present and future, caught between noise and architecture. The blueprint teaches one final lesson. Stay alert, not because danger is coming, but because opportunity is forming. Stay alert, not because markets are corrupt, but because transformation creates friction. Stay alert, not because manipulation controls the future, but because understanding controls your perspective. The long-term truth is simple. Speculation creates chaos. Infrastructure creates clarity. And XRP was built for clarity, not chaos. As long as this gap exists, short-term trading behavior will dominate. Now let us explore why staying alert matters. It matters because volatility hides opportunity. It matters because crashes reveal accumulation. It matters because manipulation often signals preparation. And it matters because long-term holders must understand the difference between temporary noise and structural transformation. XRP's journey is not defined by the price movements of today. It is defined by the infrastructure being built quietly behind the scenes. The second half of this script will expose the psychological traps, the institutional patterns, the structural forces, and the hidden signals that help long-term holders stay alert as XRP moves closer to the system it was designed for.